Hi guys, Emily here again. This is just kind of a further continuation of Learning Objective 4. This kind of allows you to see actual financial statements from public companies to kind of get an idea of how things look, where they look when they're actually reported out there for the outside users to see. So what we're kind of talking about here is a Form 10K. So a Form 10K is just an annual report for a public company. So that's going to include the balance sheet, income statement, retained earnings information. They also have cash flow. Sometimes they have comprehensive income as well. But it's just basically an overview of that, and they also have notes to the financial statement. So that's kind of everything that makes up the annual report. These are audited. They have to be audited by an accounting firm. So I am an auditor. So my firm does, audit these public companies to give the external readers some reliability when they're looking over that. And that is in the form of an accounting opinion that's also included in this annual report. Again, it is required by the SEC, one of those regulatory bodies that we talked about during the first week of class. And again, this is required for all publicly held U.S. companies. So one that we can talk about as an example is Ralph Lauren. So I'm sure most of you guys know what Ralph Lauren is, Polo for short. It's a clothing company. And here's kind of like the cover page of their filing with the SEC. So this is kind of the standard form that most companies have for their 10K. It kind of describes that it's an annual report, and it also has their legal name. So Ralph Lauren might go by Ralph Lauren, but they're really Ralph Lauren Corporation. That is their legal name, so that is what is shown on these financial statements on this annual report that they filed with the SEC. It also has different information like the area that they're a registered company, so you can see like Delaware, New York. It also has their different employer identification numbers that they got when they became a corporation, so that's also listed on there as well, and it also kind of lists common stock value, their par value, as well as what their name is on the New York Stock Exchange, or where they're registered, what exchange they're registered on. And again, this is highlighting that's their corporate name. Just as a little background, Polo does have different types of clothing lines. So obviously the one that most people know about is Polo. They also have Lauren, Ralph Lauren Sport, more sporty, Denim and Supply, Chaps, like different variations of their clothing lines, but it's still all within Ralph Lauren's company. We can also talk about another company, PVH. This again is another clothing company, similar to Ralph Lauren. And if you are unfamiliar with their brands, they're kind of made up of various different companies. So not all just kind of one brand. There's Tommy, Calvin Klein, which I'm sure you guys are familiar with, Izod, and some other various clothing lines as well. That encompasses the PHV company. And again, here is another shot from their annual report. It shows their corporate name, PHV Corp, just like Ralph Lauren Corporation was their legal name. PHV is PHV Corp. And again, it has much of the same information. It has where they're incorporated, and it has their employer identification numbers. As you can see, we've highlighted that here. Okay, so here is just kind of a question to kind of think about how you analyze these financial statements. So we want to try to figure out which company is larger. So that's between Ralph Lauren and PVH. And one good way to kind of think about who's larger company is look at their assets. And remember how we talked about assets are what you own, and that's basically how you, once you look at your liabilities, that's how you get to your equity. So the big piece of it is what do they own? So we want to look at their assets. So here is kind of the screenshot of the balance sheet for Ralph Lauren. It kind of shows their asset section here. So you can see it has current assets, kind of those same items that we talked about during the first day of class, cash, anything that's like short term that's going to be a year or less. There's that accounts receivable line item that we kind of talked about. There's also inventory, which we talked about, and then there's also an income tax receivable, same line as a accounts receivable. It's something that they are owed, within a short period of time. It's just a different type of receivable. And we also have some prepaids, which are typically within a year. And then you go down further, you can see we have our long-term assets. We have the capital assets, the property and equipment that we talked about. We have the intangible assets like the trademarks and the patents and all of that, and some other ones here as well. Deferred tax assets are just, if you think about it, the term deferred is over a longer course in a year, so it's deferred. So it would make sense to be a longer term asset. There's also goodwill, which is typically a longer term asset, and just other non-current assets that are going to be over a year. And then when you take those current and those long-term assets, you get to your total assets. So then if you go down to that total asset line item, you can see that Polo has about $6.1 million in total assets. Okay. See, then we've got that kind of pointed out there right there. Now we're going to go to PVH. So same type of thing, kind of the same line items. They might be broken out a little bit differently, but they're still the same classification of current and long term. So now if you go down to the total assets line item for PVH, you can see that they have $11.8 million in assets. So if we think back to the question that I asked, which company is larger, aka kind of look at those total assets, we can figure out that PVH is the larger company. Okay, now going on, this is just again kind of like another screenshot of the asset section. You can see again, we've kind of talked about there's line items of the cash, trade receivables, aka accounts receivables, inventories, the buildup of your current assets. And then we have below that, you have your long-term assets. And then to get your total, you include your current and long-term. So again, these are just pointing out the different line items that we've kind of already covered. Hi guys. So now that we've kind of gone over those examples, just for like financial statements, how it looks for a public company, and kind of like understanding those line items a little bit further, we can kind of finish up with learning objective 5. This is how you kind of evaluate businesses and business decisions ethically. So basically with business decisions, there's just kind of this thought process that a good business decision requires decision making and good judgment. So obviously there's a lot of things that can go into making those decisions, and it's really like an accounting and kind of different business considerations that go into that. So a business decision is going to be kind of more internal. Like you're looking at your financial information and you're deciding, how should I use, my profit? Should I, go out and have a big capital expenditure? Like, should we open a new location or something? Say I'm a coffee shop. Do we need to open another location? Maybe do we want to expand our services? Maybe we need to have more employees. Maybe we need to have more sales associates. So those are kind of like internal decisions of how the company is doing and how you want to do in the future. Now, an accounting decision is kind of, how do you record that information? How do you present that information in those financial statements that we just looked at? So you might have a decision of, wow, we had maybe like a $50,000 certain type of expenditure on an equipment or something, but where are we going to put that in a line item? Is it going to be, an operating expenditure, or is it going to be maybe like a cost of goods type expenditure? So there's different ways to classify things, and when you're thinking through those accounting situations, it's going to help you determine, how do we present that? How would a reasonable person want to see that? What are the requirements of how we present that type of information? So now that we've kind of talked about the different types of decisions you can make, there's 3 types of factors that can influence your business and your accounting decisions. And these are economical, legal, and ethical factors. So first is kind of the economic factor. In any type of business, you want to try to maximize your benefits, right? So this is about maximizing economic benefits to the decision maker. So again, you're thinking about it. What is going to be the best decision? Is going to benefit me, benefit the company, benefit those external reporters, how they are looking at my information. There's also kind of a legal piece of it too. You don't want to do something that's illegal. So you have to think about, when you're making those decisions, is there any legal impact to it? Are there any laws in place that might halt you from making a certain decision, or building something somewhere, or maybe even accounting in a certain way, like you're not allowed to record your expenses like that. You have to follow the accounting guidance. There are legal ramifications if you don't follow that. So there are kind of these legal factors that you also have to consider when you're making decisions. Lastly, there's the ethical factor. Now, something could be economically great, could be perfectly legal, but it could still not be right. So you kind of have to come from like an ethical perspective. What is right? Because a lot of people do put that in perspective. Like a company could be doing something that they think is fine and they can't be prosecuted for it, but individuals outside of that company or how it's perceived could also impact the company. If consumers or someone outside doesn't like something that they're doing, if they're letting go all these people, or something else is going on, it could impact their business because they might lose those customers. So again, you have to think of that ethical piece of it. It's also just kind of your conscience as well. You're thinking about that ethically. Same thing with accounting. There are different things where you might present in a certain way and maybe it's perfectly fine and GAAP and all of that, but maybe you want that reasonable person, that person that is reading your financial statements, to know like, wow, I had a really big loss this year and it's because of this. This is how we're remediating it. So going forward, we won't have those problems. You want to try to be transparent enough that everyone feels comfortable, that they're understanding what they are and not trying to be tricked or anything like that. Now, when thinking ethically, there are some different things you can kind of ask yourself, if you're struggling with something, and that might include, what options are honest, open, what creates like the greatest good for the greatest number of stakeholders, what options result in treating others as I would want to be treated. Again, you can't please everyone, but you still have to come from it from an ethical perspective. Now, the last thing I'd like to bring up about ethics kind of in this business and accounting decision discussion would be the tone at the top. This is a lot of things that we think about, especially me, when I'm out on a job, when I'm an auditor trying to learn about a new company or kind of understand how things function, is you want to see what the people at the top of the company do, because that will then influence employees, underneath them. If you go to a company and they have very strong ethics, they support their employees, they are very, conscious of environment, stuff like that. That is going to then transcend down to their employees, and that is going to be how they would act. Now, if the tone at the top is not very good, maybe there's been some questionable decisions, or they haven't always been ethical in what they do, not to say that that's, legally wrong or economically wrong. That may impact how the employees work as well, because they see their superiors doing it. There might be that expectation that they also do it. So just another thing to point out, that some of that does come from the tone at top when you're thinking of things ethically. Okay, guys, this is the last topic that I wanted to go over with you. And we're going to basically kind of just do a little overview of the AICPA. Now, what the AICPA is, it is the American Institute of Certified Public Accountants. I myself am a member of this, and actually all CPAs of Grant Thornton are required to be a member of the AICPA. And as being a member of the AICPA, there are different, professional code of conduct principles that we kind of have to follow. And they are listed right here on this slide. So the first one is, responsibility. So we have a responsibility to have a continuing, professional knowledge of what's going on in accounting, as well as kind of supporting, the accounting profession. So that's kind of like the responsibility piece of it. One of the bigger pieces is kind of the public interest and the integrity. So what's going on with public interest is, again, I have mentioned that obviously public companies need to be audited, and that comes from public interest. External parties, those reasonable people that we talked about during the first class, they have to have some type of reliance on us, that we're going through, we're looking at this company's financial information, make sure that it is, representative of what's going on, and it is truthful, and it is reasonable. So we have that interest in us, is we need to be able to analyze that information and then kind of communicate that to the public, which we do through our audit opinion. They also expect us to have integrity. When we're going through and auditing these companies, when we're giving our opinions, the outside world expects us to have a certain level of integrity so they can trust us that we are doing our job and that we're doing it appropriately. We are also expected to be objective and independent. So what that gets at is I should be able to go into a company and not have any bias, be able to do my job and figure out if the numbers are right or if they are wrong. And the outside world, if there's anything that's kind of impeding that could again, impact my integrity. So what independence is say if I'm best friends with the CFO of a company or something and I'm going out to audit it. Well, from afar, it might look like I might cut a break to the guy because he's my friend, and I'm not going to think objectively and do my job and be free of bias. Even though I may very well not have any impact, I might be doing my job perfectly. From the outside, it looks like there may be an independence issue, so that's also something that we have to keep in mind. It's actually required at Grant Thornton and other firms. We have to go through an independence check, and that kind of analyzes our relationships, if we own any shares in any companies or anything. And if I do have a relationship with a company or I do, own shares, I'm probably not going to be on the team to audit that because it's going to impact my independence. Another principle is due care. So again, we should practice due care when we're going out and doing our job. So we have to, our technical skills have to be right. We have to be up to date with all of our information and our accounting knowledge. We should also have ethical standards. We should continue, think ethically and think free of this independence and objections. And again, it's basically just to make sure that we have the ability to do the best that we can do for our professional responsibility with the job. Lastly, we do have kind of a scope principle, and this kind of gets back to the whole idea with materiality that we kind of covered, is, we should be determining scope and the nature of services. So there could be, there are different types of audits where there's a different range of scopes. We could do a review where we're not meant to really, we don't opine on anything, we don't give an opinion, we just kind of review the data to make sure that, it makes sense, that it appears to be reasonable. We don't do the same level of auditing as we do with a true, public company, audit. So there are different types of services that we can do, so there are scoping related to that. Okay, so that kind of wraps up that last objective 5. And what we have here is just what is going to be due, next week. So obviously we have class. We're going to be talking about chapter 2. We do have a few, more assignments coming up. We do have some more, chapter 1 detail that we're going through. But just a little heads up, here's kind of like the due dates. Here's the work. And here's what to look for week 2. Again, if you have any questions or anything at all, please reach out to me. I will help you with whatever you need. And thank you so much, and enjoy the rest of your week, guys.